Now, a few weekends ago, a group of 20 nations coming out with a statement on fiscal responsibility. They were no longer going to allow their budget deficits to grow. That marked a turnaround from the line 12 months ago when the statement was all about fiscal stimulus. Let's get more for you on that with George Lucas from InStreet with me in studio. George, essentially, how does this change the game plan when it comes to sort of markets and their response?
I think the markets have responded quite well to this, and since the statement we've seen the world markets basically rally for the last 9 days in a row, which is really the longest rally since March last year, March 09. It changes a lot of things. It changes our growth expectations. It changes our inflation expectations. It changes the way monetary policy will work. The economies will now have to rely a lot heavier on monetary policy, and so I think interest rates will stay lower and longer than was expected 3 to 4 months ago. Inflation expectations have already started to fall, and we've seen this in the bond market. We've even seen it here in Australia, where some of the banks have begun to cut their 3-year, 5-year fixed interest rate mortgages. They're all priced off long interest rates, and those falling long interest rates are beginning to flow through.
You said it changes company expectations. You also mentioned their banks. The discussion we've been having this morning is about whether banks are indeed lending at all in this environment. For all the talk of stress tests and the applause that people seem to be coming out rather well, it's all because money's been deposited in big central banks like the ECB.
And that is a big question, and it's very hard. In Australia, it's very hard to answer. It's very hard to answer in America. In America, we actually know that they haven't been lending. We can see that credit has been contracting, and we've really only had the first time that consumer credit increased in the last month. We saw consumer credit increase, but that was the first time in 18 months, so it's really not the beginning of a trend yet. Yeah. And the same thing in Europe. We haven't really seen a huge amount of credit growing in those countries, so we can say that they aren't really lending.
So when it comes back to company expectations, the next wave of reports, are you saying things are going to be revised downward? Because if economic growth is going to be lower, surely it goes true to form that company expectations will be lower.
Not initially. Initially, it'll take time for a slower economic growth to translate to a slower profit growth.
How long?
Maybe another 12 months away.
So maybe 2011 is the real kind of on a knife edge.
That's right. We're still bouncing out from companies who have restructured themselves and cut down their operating expenses, and those changes will flow through to the bottom line.
And riding the wave of stimulus as well, infrastructure contracts and piggybacking and all the rest of it.
And that will slow down. We're talking 2011, 2012. But at the moment, the company's profits seem to be on target for reaching quite high profit growth over the next 12 months. And so, this is one of the things that you have to kind of like disengage yourself from. It is possible to have slower economic growth without having slower profit growth initially. Eventually, it's going to flow through to slower profit growth. And just because we've got slower economic growth doesn't mean that the markets are going to instantaneously turn down. And in fact, we've seen them on the expectations that things may get better with fiscal tightening rally over the last 9 days.
If you're talking about monetary policy having to do a lot of the legwork now, as you said, in an environment of projected slowing growth, so what's going to be the strategy? Is it going to be have to be ahead of the curve? Do you therefore leave those rates just lower for longer? Do you tighten and loosen again? How do you play it?
You just have to keep them lower for longer. That's how they're going to have to play it, because it goes back to what you were saying before, that the banks aren't really lending. So there's no point tightening. It's not going to get people borrowing money to spend. You just got to leave them lower for longer and get the expectations that interest rates will be lower for longer. Because if that expectation comes through, people are more likely to begin borrowing because they've got an expectation that interest rates will stay a lot more stable.
Tell me about how there's a gulf though emerging between, say, the G20 and the United States overspending.
Oh, well, that was only that's another bit of news that came out over the weekend, but it's obviously been, brushed over by what happened in China. Obama sent a letter to most of the G20 members, encouraging to keep spending. Obviously, the Americans are very worried about this change in policy coming out of the G20 as well, and they want economies to keep spending and keep generating stimulus inside themselves.
Who's going to win that battle?
the markets will win, and the markets don't want economies really to be over, they want to keep, countries can spend as long as they're fiscally responsible, and the markets want countries to be fiscally responsible, and if they're not, they'll start withdrawing funding from them, like we've seen in Greece, like we're seeing in Spain and Portugal.
We've seen China, though, increasing its holdings of US debt as of last month, if the figures are to be believed. Now, do you detect perhaps an early move by Obama to be ramping up more stimulus spending by this letter, saying, well, hang on, here's an early red flag for you markets. We're going to drop more stimulus into the bucket?
I don't think so, no. At the moment, it's actually the reverse, and it's been picked up in the US at state government levels, where state governments in the US are becoming a lot more fiscally responsible.
Including California?
Including California.
How are they doing that?
Well, you may see in California really sad experiences where they'll cut the school term back by a month so that they can teach, so that they don't have to pay teachers for an extra month.
So the kids get the raw deal.
Yeah, and then you're going to see some you're going to see some really strange things, and you're already seeing it. In November, there's going to be a referendum in California to legalize marijuana, and obviously the legalization of marijuana will take a huge drain off the state's, crime-fighting bills. Yeah. So there are processes underway in all the states to cut back on their fiscal spending.
All right, let's just jump ahead if we can, and you've got some information on global fund managers, a survey there, and perhaps a bigger picture sense of what's going on globally. What caught your eye?
I think what caught my eye is that the fund managers feel that the markets globally are undervalued at these levels. However, they're still very cautious. And that's actually not to be expected. This is a global fund manager survey, and obviously the Northern Hemisphere is going on holiday for the next 3 months for their summer holidays, but there's still a lot of caution in the air, even though they still think the markets are undervalued at these levels. And
that, I guess, is underscored by the high levels of cash that they're holding.
Yeah, they tend to be holding quite high levels of cash. The cash hasn't been higher than since May 2009, so the cash levels will provide support for the market.
Are they distinguishing here between emerging and developed markets?
They are, and it's the first time in a while that we've seen the emerging markets come back into favour from global fund managers. They actually have been out of favour for a long time with global fund managers, and that's at the detriment of Europe and the US. We've seen them move back towards emerging markets.
So is there a tipping point where that sort of overweight cash position, money is being put to work? Are they indicating sort of a timeline, given what you just said there about globally possibly things starting to cool off into next year?
I don't think they are. They're worried about things cooling off into next year, but I don't think they really are setting a timeline. I think catalysts, and we've always talked about this, about what's the catalyst. I think we've had two quite good catalysts over the last 2 weeks. One of them was the Chinese unpegging of the currency, and the 2 weeks ago with the G20 statement on fiscal responsibility have been quite good catalysts for the market.
They're quite bullish on energy stocks, these fund managers, particularly in the wake of the BP disaster, it would seem, from what you've highlighted. And yet we haven't seen big price spikes in crude. So
I actually think they've gone negative on...
They've gone negative, have they?
Yeah, and they're tilting more towards defensive stocks.
All right.
Tech stocks are still very much in favour.
Okay.
And then the defensive stocks like telecom and utilities. And obviously today we're going to see Telstra rally quite well.
People have said, though, that that's almost the herd mentality, that everyone is perhaps heading that direction. So going overweight defensives, and yet when things do turn around, you've got to be ahead of that to
have to be ahead of
capturing the cycle up.
And we've talked about that quite a lot here. It's not only being ahead of it on which sectors, but also on markets, and that eventually the markets would stabilise. And this survey is a past-looking survey, and it's just giving you an idea of what they're doing. It doesn't necessarily mean you should go and follow them.
Yes, past behaviour pointed to future moves. George, have a great week.
Thank you very much.
Thanks for coming, as always. We'll see you next time.
Okay.
George Lucas there from InStreet.